Well, hey everyone. Welcome to Chart This with Dave Keller. Happy Thursday, February 12th. I'm your host, Dave Keller, coming to you from a beautifully sunny and clear Redmond, Washington. I hope you guys are all doing well, staying warm, despite some cold chill running through the financial markets here today. Boy, this day started bad and got worse. And that's not true. It actually started with the gap higher. The Dow opened above yesterday's close, as did the S&P, as did the Nasdaq. But did not take long. First hour of trading, we started to break below yesterday's close and then accelerated. In the last hour of trading, not great. And so, if you're looking for institutions coming in the late hour and saving the day and providing a good upswing into the close, today was not a day for that kind of late inning magic. This was a day of pain for risk assets. There are very few things that are green today. We're going to do our best to focus on them, notably the VIX, which a green VIX, usually not great because it closed above 20, which is our red flag threshold for volatility. Also, bonds closed higher with the TLT up about 1.33% as rates generally moved lower today. You know, we've been talking about the strength in the AI trade all through 2025. We talked in Q4 of last year and through the beginning of this year about how there's been such a rotation away from growth into value, away from large caps into small caps, away from tech into things that are not tech. And I think today is one of those days where you see all of those things happening. This was a day of celebrating the general trend here of 2026. Now, keep in mind, the S&P did not break down through any key support levels just yet. I mean, it finished below 6,900, but not by much. We're back in the yellow light district, but it's not horrible yet, right? The chart's still okay from a long-term perspective. So what we're going to do is focus on what happened, but then really lean into some of those key support levels that we're watching, what we call our lines in the sand, and we'll see what happens. By the way, it's been a week since I posted that video asking people to think about 4 different paths of the S&P and which they thought is most likely. If you haven't done it yet, hey, still time to do it. Take a look at it on my YouTube channel because I'm curious, given what's happened, if the comments coming in more recent have a different flavor than the votes we had a week ago. It would be a very interesting thought experiment. As always, 3 parts to the show. We'll start with a review of the major equity indexes today. Lots of red. We will look at the heat map and talk about some sector and group and stock themes. Again, lots of red on that one too, but there we'll focus on pockets of strength. On a big down day when it feels like everything's down, some things were up. So let's make sure we recognize those. And then finally, I've hand selected actually quite a few charts. There's a lot to talk about today, so I'll get through those as quickly as I can. Here's what's going on. All red on the front page except for the VIX. The S&P finishing down 1.6% to 6832 and change. The Dow back below the 5,000 level, finishing just about 49,550. That's down 1.33%. The worst performer, the Nasdaq Composite, down just over 2%, finishing just below 22,600. Mid caps and small caps, while they outperformed the S&P in terms of the mid caps, still down 1.4%. Small caps actually the worst out of the 3 cap tiers, down 1.8%. So this was not like small and mid caps worked and large caps didn't. This was kind of a weakness in large cap growth drags everything down kind of situation. And what we experienced today, I would argue from a kind of macro technical perspective, that is the biggest risk to this market is that, what we've seen so far in 2026 is large cap growth struggling, but other areas of the market looking quite good, right? So large cap and even small cap value, large cap defensive sectors doing good, utilities doing okay, healthcare doing good, energy doing great, material stocks, steel companies all doing good. But days like today remind you that if the AI trade gets really bad and if these technology names really start to struggle, it starts to, erode confidence in equities in general, right? And so for a while there, it can be just a rotation. But when a rotation becomes a bear market, it's instead of just rotating from what's working previously to what's working now, if everything stops working, then we have a real problem. Then that's when people are moving out of equities into something else. And that's the danger here, folks. Having said that, the VIX moving higher, it accelerated going into the close as stocks sold off. Closing back above 20, that's a red flag level for us. VIX above 20 tells us high likelihood of further deterioration. So we'll certainly keep an eye on that going into Friday's session. Rates generally moved lower today as bonds rallied. I would say this is a sort of a flight to safety trade with the TLT up about 1.33%. That's a long, sort of long end of the curve Treasury ETF. 10-year yield finished just above 4.1%. The long bond yield now around 4.7%, and the 5-year point just below 3.7%. The dollar was actually surprisingly flat. No real significant move in the UUP, which is a dollar ETF. Big pain in the commodity space here. So if you're looking for gold and silver as safe havens, not happening. What you have to remember is gold and silver have actually been rallying along with equities recently, and in recent months have actually been more positively correlated than anything. We saw that in 2025 when stocks did quite well off of the April low. Gold and silver outperformed in 2025 given their strength. So today, stocks down, gold down with the GLD down 3.4%. Silver, which has become a much more volatile experience like gold, same group, but bigger swings, down almost 12% today. Copper prices lower, energy prices lower, particularly the crude oil ETF was down over 3% today. Looking at cryptocurrencies, hey, we got to celebrate the color green everywhere we find it. Cardano and Kronos, two of the not the top 10 coins on stock charts, but certainly not as popular as Bitcoin and Ethereum. Those are the two big ones, but the rest of these popular for different reasons. So a couple of these up, but most cryptocurrencies down, with Bitcoin and Ethereum both down. Bitcoin currently trading just below 65,500. That's down just over 2%. Ethereum price is nearing that 1,900 level. So continue to see risk-off action in Bitcoin for sure. All right, looking at the 11 S&P sectors, not good is how I would describe this. The only three sectors that were positive, three defensive sectors. Utilities were up 1.5%. Consumer staples were up about 1%. Real estate up just slightly, 0.2%. Healthcare, the fourth defensive sector, basically flat. Down 0.2%. That's it, right? So the defensive sectors were the juice today. The defensive sectors not just didn't go down as much, they actually went up a little bit. And utilities, look at this. When I'm looking for stocks making new relative highs, when I'm looking for stocks making new 3-month highs, I'm finding a bunch in utilities and consumer staples. And while, we could argue whether or not that's a really good, really bad thing for markets, I would say it's generally not a good sign when the only sectors doing well are very defensive sectors. That tells you that investors are rotating into the defensive areas of the market. They're looking for stability. They're looking for lower volatility, looking for higher yield. Still early days for this sort of trend to emerge, but this is the risk we've talked about is, one of those shifts to look for is a rotation to defensive sectors. For what it's worth, today was definitely one of those. On the downside, the biggest sector in the U.S., the technology sector, down 2.7%. That hurts a lot. That's why the major benchmarks are down significantly, because tech is a huge weight, obviously in the NASDAQ 100, but definitely in the S&P as well, where it's about a third of the weight of the S&P. The financial sector down another 2%. We talked about, some of those charts in the XLF that have been, looking less good and now starting to just be in clear breakdown scenarios. And we're seeing more of that here today. Energy and communication services both down about 1.8%. The growth sectors have been struggling. Energy, this is a bit of a change from what we've observed as crude oil prices have been rotating higher in January and February. The energy sector has started to really outperform. Today, it's actually down with some of the other growth sectors. The breadth was not good today, and the breadth has been fairly strong. That's been one of the positives about the market conditions here in 2026 has been consistently strong breadth. We've seen the advanced decline lines generally make new highs in January and February. Not today. Today, 2-to-1 ratio, stocks down versus up. That's about 68% of the New York Composite Index versus 30% that were advancing. On the S&P 500, 68% of that benchmark was down. In the small cap space, 77% of the S&P 600 finished in the red today. The Magnificent Seven and friends, we have Alphabet and Microsoft, your top performers, but they're all down today. Alphabet, testing, support, making a higher low for now, holding support, but starting to break moving averages as we highlighted earlier this week, down 0.6%. Microsoft, which has been a struggling chart for a little while here and certainly weighing on the technology sector, down 0.6%. Nvidia, and I'll come back to that one because I incorrectly yesterday said Apple was the only Magnificent Seven stock above both the 50 and 200-day. Nvidia was there as well. And thank you for many of you astute viewers that caught that mistake. Boy, I am not perfect. I will tell you, one of the great signs of a mindful investor is you recognize your imperfections. Mindless investors believe they're perfect. They're overconfident. They assume they're never going to make mistakes. I openly embrace my ability to make mistakes way more often than I would like sometimes. And that comes to typos and little verbal glitches and also just completely messing up the facts. So my bad. Nvidia and Apple, as of yesterday, both above the 50 and 200-day moving averages. That changed today going into the close. So I'll look at the charts of Apple and Nvidia here in a moment. On the downside, Apple down 5% today. Netflix down another 4.7%. Broadcom, one of the big semiconductor names, down 3.4%. So this was a day when kind of everything was rotating lower, but particularly growth struggling quite a bit. What you're going to find, I think, when you follow the breadth conditions, the breadth is still going to be okay. Today was a pretty negative breadth day. So things like the McClellan oscillator probably rotate below zero because it was such a big down day in breadth. But long-term measures of breadth are still good, right? Most stocks in the S&P are still above their 50-day moving average. Most stocks in the S&P are both above their 200-day moving average. We can get nervous when that doesn't happen anymore. For now, it's still okay. All right, before we get to this beautifully red-tinged heat map, as a reminder, questions are always welcome and very much appreciated. We are planning an all-mailbag episode on Friday of this week. We would love to answer one of your questions on the air. By the way, no new episodes of the Market Misbehavior podcast yet, but I had a really good interview a couple hours ago with Rob Hayworth of U.S. Bank Asset Management, based actually here in the Seattle area. Really knowledgeable macro strategist. Great questions that he answered, or great answers to my questions. I should say about macro conditions, about the Fed, about economic data, about what we can really learn about the state of the consumer, about the health of companies in terms of jobs data, about the impact of tariffs. But then connecting that all back to prices and momentum, where he agreed to go with me. Really good conversation. And if you're trying to understand more about those sort of non-technical factors happening, and which are so crucial, I think, for being a holistic, well-rounded investor, that episode should be ready for you tomorrow. So I hope you'll keep an eye peeled for that on the Market Misbehavior podcast. All right. Lots of red to talk about. So here's what we're going to do. We're going to talk about the things that we're struggling, and it's in some of the growthy sectors, but also some others. And then we're going to focus our time and attention on things that didn't go down. And I would tell you, this is something I learned a long time ago. When you have a big down day like this, usually not everything went down. As a matter of fact, it's very rare that everything goes down. Something somewhere went up, because there's some companies that, for whatever reason, are going to buck the trend, are going to do the opposite. Same thing on a big up day. You're going to have some stocks that are pulling back. And that can be helpful to go into, because what that will remind you is that even though the broad indexes were down, even though most stocks were struggling, there were some pockets of strength. This is where investors were actually, encouraged. And so understanding where those stocks are, I think, is very, very helpful, particularly if we do get into some sort of pullback scenario and we get into more of a bearish phase, which I think highly likely here in the first half of 2026. As I shared in our 2026 market outlook for my premium members, first half of the year is probably going to be pretty chunky, sloppy, and most likely negative. That's what often happens in a midterm election year. And so far, haven't had a lot of big price deterioration in the benchmarks, but we've certainly had some choppiness. So we're seeing more of that here today. So let's look at what is the most red in here. Obviously, in the upper left, technology. But again, keep in mind there are some areas of the market that were green. We'll come back to those, but let's focus on the fact that Apple's down 5% today. That's not great. Cisco, one of the big ones, down 12% today. This is after earnings. I mean, and again, this is what we talked about with the AI trade. The risk here is all these AI companies. There's been a ton of spending on infrastructure. There's been incredible growth and accelerated growth and expectations for how well these chip-related names will continue to go, how well the AI trade will continue to flourish. And anytime I hear that sort of discussion about how it's just going to keep going up because this is the new thing, I've just been through too many of these bull cycles, these bubble-like experiences where it's like the same like quotes, it's the same articles. You just swap out .com for AI. You swap out home housing for AI. It's like it's just the same thing, right? Books about bubbles, many of which you can find on the marketmisbehavior.com recommended reading list. Things like manias, panics, and crashes. They just show you that it's just that the market never repeats itself, but it often rhymes. These bubble-like things where an investment theme becomes so obviously bullish that you can't imagine not owning them. That's usually when you're in some sort of bubble. And we're definitely seeing that sort of bubble-like pullback, that bursting of sorts happening today. So Apple down 5%. This is a great company and a well-established company losing 5% of its value. Cisco down 12.3%. Palantir down another 5%. That's making like a fresh 3-month low today. Applied Materials, pulling back. So some of these are still great. I mean, right? IBM is breaking down. Applied Materials is still holding up. So I think you have to start to differentiate the stocks that are, just sort of stalling out in an uptrend, things that are actually full on breaking down. And I think that's where moving averages can be so valuable. What's different from, what am I thinking? What's different from like an Applied Materials versus an IBM? Both were down today, but Applied Materials is down 3.4%. It's still in a primary uptrend, right? The moving averages are still going up. We're still above all of those. IBM is also down, a little more, right? 4.9%, but it's broken down through support. The moving averages are all rotating lower. It's not holding the 200-day. Just look at the momentum, right? Look at the price momentum, the RSI on Applied Materials, where the RSI is around 56, 57 versus IBM, where the RSI is down around 32. That difference in that value of the RSI indicator tells you quite a lot between one stock where the momentum is still largely okay versus IBM, where the momentum is clearly more negative. So the way that you differentiate between stocks that, when everything's down, what's down but still okay, what's down and it's an uh-oh. The uh-ohs are where we break clear levels of support, where the moving averages start to change and shift their slope when the momentum shifts more into the bearish range. And I think that's an important way. When everything's kind of red, remember, not all of these charts are the same. Use this as a starting point to look at the technical configuration. Stick with charts that are good charts and not charts that are struggling. AppLovin down about 20%. That's the most recent earnings disaster before Cisco today. So again, the concern I have are big technology names with some ugly earnings, and now the stocks are getting dinged very, very quickly. The problem is, this growth theme is just very overexposed in our benchmark. So if that theme starts struggling, our benchmarks can go down very, very quickly. So within technology, what's still holding up? The hard drive names, Western Digital and Seagate, both up pretty good today. Motorola Solutions, MSI, sort of different, right? It's more of a telecom name, but up about 7.7%. I'm not going to talk about ServiceNow and Adobe because they were up, but those charts are absolute dogs. So I won't spend another moment on them. Akamai Technologies making a new 52-week high today. Zebra Tech up 8.3%. This is not a great chart. And again, on the surface level, up 8.5%. But look at the chart here. We opened above the 200-day, but closed back below it. So this appears to be what we would call a gap and fail, which is where you gap higher, but were there a bunch of new buyers coming in and buying the gap? There were not, right? After a couple hours, it was very clear that investors were selling out of that strength. And what's happening is it's a flight away from growth and technology in general. So something like this with a big gap higher, it's like, thank goodness I can, at least book a profit on this trade and get out quickly. And that's what causes this price to do that. So, company, and again, I don't know a lot about their earnings release. They report earnings today. But my technical assessment would be the earnings are pretty good because it gapped higher, but the fact that investors are selling in that strength is more of a broader risk-off mentality. And just bull markets don't thrive when it's a risk-off environment. When people are selling good earnings names, that's not a good sign for the markets in general. Within communication services, and I think this is the same thing yesterday, there are some good winners today, but it's sort of the big telecom names: AT&T, Verizon, T-Mobile. Good mobile play, having a nice rotation higher. Within healthcare, the top 5 stocks were actually positive or flat in the case of Merck, but the top 5 holdings in the XLV were actually up today, right? Johnson & Johnson made another new all-time high. Within the discretionary sector, again, the two biggest names, Amazon and Tesla, both struggling, but McDonald's made a new 52-week high today. TJX, which did not make a new 52-week high, was up about 2.5% today. So this is the pattern, right? You can see the pattern that I'm going on here. In every one of these sectors, there were some stocks that were down quite a bit, and that was what happened to most names. But in every one of those sectors, there's some areas of strength. That's where I would focus your attention. If you're going to be looking for opportunities, focus on stocks that are holding up. Focus on, aerospace defense names like HWM, like NOC, like RTX, like Boeing, like LMT. Those stocks were all up today on a time when the market was down. Final comments I would make here is just the strength of defensive sectors. Look at consumer staples. Top 5 holdings in the XLP were all up today. Walmart made a new all-time high. Within utilities, a lot of these names were up. Charts like EIX, charts like NEE, charts like AEE, which is Ameren, made new 52-week highs. Charts like Southern made new 3-month highs. So you're seeing strength in defensive sectors, particularly consumer staples and utilities at the top of the leaderboard. All right, we're going to continue on looking at some charts that I have hand selected. Starting with the daily chart of the S&P 500. Quick shout out to our friends at Seeking Alpha. Thank you guys so much for being great partners to Market Misbehavior. They are running a Valentine's Day sale this week through February 15th. You can get a better deal than normal on their Seeking Alpha Premium, which is basically gets behind their paywall, allows you to access Seeking Alpha's contributed research, also access to their quantitative model run by Steve Kress and the quantitative team there. Great ways of identifying strength in the markets, great opportunities to evaluate your portfolio, kind of take it to a health check, like going to a wellness check with the doctor with your portfolio. You can find more info at marketmisbehavior.com/seeking alpha. You can also scan the QR code that you see on your screen. Again, I appreciate you taking the time to check them out. Partners like Seeking Alpha help us to make Market Misbehavior awesome, and I've enjoyed using their platform. Hope you can check them out as well. All right, looking at the daily chart of the S&P 500, we are back in the yellow shaded area. That means we're in the yellow light district. It's not the red light. It's not end of the world sort of movement, but certainly getting further and further from that 7,000 level. Who knows? We might finish the week in a brilliant up day, but it certainly has a risk off feel to the week here with Tuesday, Wednesday, and now Thursday closing below the open, right? So each one of these last 3 sessions, we've opened higher and then closed lower, and that's just not a great read. That sort of implies that at least in the short term, we're seeing some risk-off behavior. We're back below the 50-day moving average for the 3rd time in 2026. The last 2 times here in mid-January and then here last week, we closed below the 50-day for 1 day only and then bounced higher. If that happens on Friday, I'll tell you conditions are not that bad. But if we get further deterioration, particularly if we break below 6,800, that would be a new monthly low. And I will tell you, we are very much in a neutral footing at best. Still watching that 6,550 level. The 200-day moving average is a little below that at 6,500. But I think that's your cluster of support. That's what we call a confluence of support, where a number of different technical indicators all coalesce around a particular level. I think anything above there is still okay. I mean, the yellow shaded area, we're not great anymore. We're okay, but okay is still okay. Breaking below 6,550, I think, becomes not okay. I think that's a bear market phase. The momentum's still neutral, even though the RSI came down a bit. We break below an RSI of 40, that would be a dangerous sign as well. The long-term breadth conditions, as we mentioned, still remain quite good. We still have 2/3 of the S&P above their 200-day moving average, but we're down to 62% above their 50-day. Both of those well above the 50% level. That, which happened most recently in October of last year. That's where we have to start to question maybe the sustainability of the uptrend and the elevated possibility of a further drawdown. Newer Dow theory starting to look more and more like a big bearish non-confirmation. This is derived from Charles Dow's work in the early 20th century, where he wrote a series of essays for barons and talked about confirming economic strength by looking at the producers of goods and the distributors of goods. He used the Dow Industrials and the Dow Railroads. A modernized version that I like to use is the equal-weighted S&P and the equal-weighted NASDAQ 100, kind of the old economy and the new economy. If they're both going up, things are probably pretty good. If they're both going down, things are definitely pretty bad. If one's breaking out and the other one is not, that's a bearish non-confirmation. according to Charles Dow's work, that tells you there's an issue there, right? With part of the economy doing okay and part of it not. In this case, we have the equal weighted S&P making a new all-time high this week, but that new all-time high was not confirmed by the equal weighted NASDAQ 100. We had this before back here in December. That was alleviated by both of them eventually making a new 52-week high. We'll keep an eye on this divergence, but for now, bringing the most recent price action certainly into question. The volume's generally been okay on the S&P 500, but today with a big down day, closing near the lows, which with a lot of volume. This is the volume on the SPY. This is the heaviest volume we've had in about a month. And the problem is that heavy down day on heavy volume changes the volume indicators in a lot of ways. Here's the Chaikin money flow going below zero. Excuse me. It's gone below zero a couple times. These have been during these pullback phases. If you look like in November, look in December, here in January, some of these drops have seen the Chaikin money flow go below zero. This has a 1 month look back, the version that I use. So it's looking back at the last month, measuring the daily volume reading and gauging where we closed within the day's range. So the fact that we're going below zero basically says over the last month, we're starting to see more signs of distribution. That is not a good sign. You can see all the big down days on heavier volume that we've experienced in the last month. The volume's starting to look a little more distributed, and I think that's a potential change here in mid-February. The volatility now spiking higher, closing above 20 for the third time in 2026. The last two times were in those tradable lows in January and February, early February. So 2 times now so far we've gone VIX closing above 20 for 1 day only. The price has pulled back to around 6,800. It's been a pretty decent price swing higher to retest 7,000. Does that happen again? If not, right, if we hold the VIX above 20 and if the S&P closes below 6,800 tomorrow, that would all of a sudden be potentially a different environment. Investors are getting a little less bullish here. Here's the AAII survey. The levels of bulls were pretty consistent, but look at the increase in bears. We went from around 30% to around 38% from last week to this week. That's a pretty big shift. And all of a sudden, for the first time in 2026, almost dead even with bulls and bears. So what that means is that there's a neutral level that I'm not showing here. And what happens is some neutral people went bearish. It's sort of like the independent voters siding with one side here. It's starting to be a shift. So the people that are bullish are still pretty bulled up. There's no real change there, no skepticism on that side. But some of the undecided voters now voting bearish is how I would interpret this signal. That's not a good sign, I would say, particularly if you get a bigger rotation and bears start to outnumber bulls. We're also seeing steady deterioration in the name exposure index. This week's number comes just above 80%. About 6 weeks ago, we're teasing 100%. As a matter of fact, in mid-December, we were above 100%, which for me is a dangerous contrarian sign. That tells me investors are getting a little too bullish. So from that moment, the name exposure index has been steadily declining. In the last couple of weeks, it's really getting low. Now we're kind of right around the average allocation. So money managers in this survey starting to lighten up in the new year. Even though the S&P is holding ground, money managers in this survey are starting to lighten up on their exposure to equities. That, I think, is a potential shift, certainly to monitor. We talked about how gold and silver were both down pretty good today. Silver, obviously down double digits. That's a big painful move. We've seen increased volatility on the way up and also on the way down in January and February. Today, the GLD closing just above the 21-day EMA. That's something to watch. If we would break that, I'm looking down around 417 to 425. That's sort of this area with a 61.8% Fibonacci retracement. Also the 50-day moving average. As long as we hold that, I think we're still okay. But this was a pretty significant pullback. Still holding key moving averages for now, but we're going to watch that gold position. We have a position in GLD at the moment. Bitcoin, I don't have a position in Bitcoin anymore. I took it all off because the chart just looked bad. I always say at the end of the episodes, it's always a good time to own good charts. And I guess the corollary, it's rarely a good time to own bad charts. Arguably, it's never a good time to own bad charts. I don't want to say never, but probably close to never, right? Very, very few exceptions to that rule. Bitcoin had a nice counter trend bounce after hitting 60,000, bounced up to around 72K. But now, so far this week, as equities have gone risk off, so has Bitcoin. We talked about the larger structure, right? And so we're continuing to make lower highs and lower lows. The momentum is still negative. I'm inclined to be interested in Bitcoin when those things are no longer the case. We're still deteriorating in terms of price and momentum. Look for a higher low, look for a bullish divergence, look for some signs of accumulation. I'm not seeing that on the chart just yet. I tell you areas of the equity markets where we are seeing signs of accumulation, defensive sectors. You can see healthcare here, pretty much a market performer in 2026. But now in February, utilities, consumer staples, and real estate all outperforming. Those are the only three sectors that were actually absolute terms up today. Actually gained value with utilities at the top of the list. But look at the improvement in relative strength. We've highlighted this chart before, particularly in December of last year. I remember bringing up this chart and saying, look, things aren't that bad until and unless we start to see a real improvement in defensive sectors. You're starting to see that here in February. That's probably one of the more concerning patterns I can show you. All right, let's get to some stocks that moved. There were quite a few. We don't have time on a show like this to go through all of them. But for my market misbehavior premium members, you have access to a member community. Any charts you're looking at, any tickers, you can drop it there. And I will make a point of sharing some charts and some thoughts. It's never too late to become a premium member. You can find more info at marketmisbehavior.com/premium. Don't forget to use the code YouTube. We'd love to have you as a premium member. The member community is a really cool place where I get to answer questions every day, get to nurture investors through a journey to a more mindful investing and better routines. I'd love to have you as part of that as well. Marketmisbehavior.com/premium for more info. And don't forget to use the code YouTube. AppLovin was earnings on yesterday, did not go well. And we can see that as evidenced by the fact that we have a 20% haircut in the stock today. What happened now on the chart of AppLovin, you have, it's a weird set of patterns. So I normally start calling this an island reversal, but now that you have a couple islands, I don't know how helpful it is. I guess you would technically call this a bullish island reversal and then immediately followed by a bearish island reversal. I highlighted how this chart is not technically an evening star candle pattern. And the reason is because day 3 would need to be a big down day. An evening star pattern, just so you're aware, is a 3 candle pattern. Day 1, big up day. Day 2, open and close very close to one another, and we've gapped up a bit. Day 3, big down close. And we just didn't get that third down close. However, today was certainly a big down day. And I would argue it probably makes that a bearish island reversal and a bearish sign. So we're still holding that low from last week, but not by much. And so I think we're, definitely in a pattern of lower highs and lower lows. You see this is a failed attempt to regain the 200-day, whatever you want to call it. It's not good. Even just drawing some trend lines from those major highs can be a way of just recognizing the fact that we're in a downtrend and you want to find when we're not anymore. But that's a big, obviously, a name that did quite well at times in 2025. Now just a huge topping pattern and now just failing to hold support. The chart of AppLovin, I think, is what generally technology feels like right now. I will happily admit my mistakes anytime I can catch them. And a number of you caught this. Put a comment on our YouTube channel. Thanks for that. Anytime you want to correct me on something I miss, it'll happen a lot. I often swap the words bull and bear, and I say those words so often. It's never intentional when I mess them up. So apologies for that. But I did incorrectly say that Apple was the only stock above its 50 and 200 day. The bad news is it didn't last for long. So Apple now below the 50-day moving average with a 5% drop today. This is part of that broader rotation away from technology and away from growth and away from AI today. Apple now below 4 trillion market cap again, and quite a drop. That hurts a lot for the XLK, for the QQQ, where Apple is one of the biggest weights in both of those benchmarks. So, certainly the question was, do we regain that December peak? For now, that seems a lot less likely as we're breaking below the 50-day. And, looking at support down here around 245, 240, that's the January low. That's the 200-day moving average, neutral chart as long as we hold that level. Nvidia now at this point, after Apple's drop, remains the only stock. So as of yesterday, there were only 2. Now only 1 remains. Nvidia, the only one holding its 50 and 200 days after Alphabet broke below its 50-day moving average. So Nvidia, honestly, I mean, it's an okay chart. It's been an okay chart for quite some time, right? We're sort of bumping up resistance around 193 to 195. That's happened a bunch of times going back to the end of December. The neutral momentum is what tells me there's just a sideways chart, similar with the S&P. I mean, these are sideways trends with neutral momentum. They're just not great opportunities. Cisco had been a pretty good chart going into today's earnings release, or yesterday's earnings, I should say. Today, we saw the negative reaction after the close yesterday. Today, gapping down at the opening just below $80 a share. By the close, we closed right at $75 a share. That's down 12.3%. That takes us back below the 50-day moving average. And again, all I will say about this is I stand by the argument that as of yesterday, this is still a good chart. A great chart, honestly, making higher highs and higher lows. The gap lower today happens, and earnings-related gaps are just a reality of investing in stocks. If you want to own individual names, you have to accept that this is a very real outcome to an earnings release at any point. So let's take a step back. From a technical perspective, what can we say? Well, the good news is we're still holding that January low right around $73. That's why I have an alert set. Cisco below 73, I don't think is a good chart anymore. The 200-day moving average is right around 70. The last time we tested the 200-day was at the April 2025 low. We chopped around there for a bit, but it ended up being a fantastic buying opportunity. Maybe more of the same, we'll have to see, but we're nearing the point where if Cisco's still a good chart, better find some stability here pretty quick. Man, I hesitate to want to bring up Coinbase in the aftermarket just because I don't know how earnings are going to go here. I'm skeptical. Oh, it's up in the after hours. How about that? Maybe they had some pretty good earnings here after the close. I haven't had a chance to look at it yet, but Bitcoin has been in a primary downtrend, as has Ethereum. Coinbase is basically an equity way, way of playing cryptocurrencies, right? Because you're buying a company whose business is built around crypto. It looks like it's up a bit after hours to around 145 and change. That's not much. I mean, that's like right around there. So for now, apparently holding it. I talked about Coinbase as a long-term play. So if you look at the weekly chart, you see this like 140 to 145 range, major lows in April of last year, September of 2024, right around that same level. So if you get a good earnings release and it bounces, I can't imagine Coinbase does particularly well if Bitcoin and Ethereum continue to deteriorate. But from a technical perspective, holding support is never a bad thing. So let's see. Now, we've had a lot of red. We've had a lot of downtrends today. So let's finish in a position of strength. Johnson & Johnson. Johnny John made a new all-time high today. All right. So friendly reminder that there are stocks out there that are looking remarkably good. There are stocks out there where the moving averages are in the proper order with the price above the 21-day EMA, which is above the 50-day simple moving average, which is above the 200-day. Charts like Johnson & Johnson are out there. So I would encourage you, if you're struggling to find good charts, you're probably just looking in the wrong sectors. Use a platform like Stock Charts, like Optima, like Seeking Alpha. These are some of the platforms that I use. Look for stocks. If they have good technical analysis scanning capabilities, look for stocks where the moving averages are in the right order. That's a great place to start. Stock Charts actually has a built-in scan for that. If you go to Stock Charts, go to the sample scan library, which is free to access. Moving averages in correct order. That will give you charts like Johnson & Johnson, which are in a primary uptrend. As I finish the show every day, it's always a good time to own good charts. So remember, if you own bad charts, that's on you. You are missing the opportunity to own a better chart out there somewhere. Folks, that'll do it for today. This was fun. Down days are never fun, but I tell you what, I tend to smile just because it's interesting. It gives us plenty to talk about. And I think recognizing the difference between short-term weakness and long-term deterioration is important. Recognizing what levels, what lines in the sand that you're going to watch. That allows you to stomach a day like today. Because if your line in the sand isn't broken, then things just aren't that bad anymore. But make sure you clearly define your risk today. That'll do it for today. Thanks for dropping a question in the comment section below. We'll plan an all mailbag episode on Friday. In the meantime, have a wonderful evening. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Take good care, folks.